All right, everyone, and welcome to this week's episode of DoubleLine Minutes. I'm Sam Lau here with Mark Kimbrough.
Hey, hey.
It's 10 a.m., just after 10 a.m. Pacific here on November 22nd. It's hard to believe we're heading into the last week of November, and then after that, the last month of 2024. But it's a pretty quiet week as we go into the Thanksgiving holiday. So go ahead and kick it off with the market side of things. But looking across the board right now, things look pretty benign. I mean, the S&P 500 is up 1.7% on the week-to-date basis. Month-to-date, as we get into the final, days of November here, but as of right now, it looks like it's going to end the month on a positive territory unless something pretty big happens next week. But month to date right now, we're up 4.7% on the S&P 500, and then year to date, unless something drastic happens again in the final, let's call it, 5 weeks or so of 2024, it's going to end pretty strongly positive. Right now, it's up just under 27% on the S&P 500 on a year to date basis. Everything, with the exception of healthcare, looks to be in double digits and beyond. Healthcare right now, the worst performing sector on the year-to-date basis, up 7%. The next best or the next worst sector right there is materials, but that's up almost 12% on the year-to-date. So that kind of gives you a sense of a little bit of how disparate it is between the bottom two right now. But for the year-to-date basis, double checking here, but it looks like financials up 36% is the far and away the best performer. But across, bring it back to week-to-date right now, it looks like across all 11 sectors, we have positive numbers across the board there, with energy and utilities and materials leading the way, each up over 3% on the week-to-date basis. Moving over to fixed income land, starting with the treasury yields, looking across right now, the 2-year note is up 6 basis points in yield, up to 4.36. Down to the 10-year treasury is at 4.41. That is 3 basis points lower than where we closed last Friday. And then for the bond, the 30-year treasury is at 4.59, also in 3 basis points on yield versus the close last week. So what does that mean for the broader bond complex? As measured by the Bloomberg U.S. bond aggregate, that's up about 20 basis points week to date. Also a clean sweep across all of the various cohorts that we review each week. The worst performer there is going to be the U.S. Treasury sector, down up 12 basis points. And then we have IG corporate credit up 20 basis points as the next one. And then bank loans up 25 basis points. Best performer here is EM sovereign debt, up 60 basis points on the week there. Similar to what we just talked about the S&P 500 as well on the year-to-date basis on the cohorts that we look at for the fixed income sectors, we do have a clean sweep. Worst performer here is going to be the U.S. Treasury market, up about 90 basis points or so. The best performer here right now, and it looks like for the most part, it's the below investment grade U.S. corporate sectors there, with high yield corporate credit up 8%, and then bank loans up about 7.5% or so. That's followed by EM sovereign debt up 6.5%. But again, a clean sweep of positive sectors, both within the bond and the U.S. equity indices there. Now, wrapping it all up, looks like commodities also had a positive week this week, up 3% on a week-to-date basis. Year-to-date, it's up 5%. So things are looking pretty good for 2024 thus far. Right now, some of the commodities that we look at within the broader within the broader commodity index for the WTI crude front month futures, that is down on a year-to-date basis, down 50 basis points, but certainly helped this week. It's up 6%, over 6% on the week-to-date basis. We're back above the $70 mark on the front month contract of crude, based on some of the increased, I guess, geopolitical risk that we're seeing out there, unfortunately. But right now, WTI crude oil is at $71.30. Gold also having a very strong week, up 5% for the week to date. Year to date, that's up over 30% again on the front month futures contract there. But right now, we're just hovering above $2,700 a troy ounce for a one troy ounce of gold. So with that, Kimbrough, do you want to jump us off on what happened on the macro front this week?
Yeah, we'll do. Super short week this week. I'm actually going to skip ahead to yesterday and start with our weekly labor data that we get. That's the initial jobless claims for the week ending November 16th. This came out with a print of 213,000. That's 7K below the estimates, 6K below the prior. This was the lowest print we've seen on initial claims since April this year. So I'm just going to go out and say that it's settled back down following, a little bit of the turbulence we had following some of that storm effects. But on the other side, we got continuing claims for the week ending November 9th. That printed at 1.908 million. That was 28,000 above estimates and 36,000 above the prior. This has not settled down. I was, hoping that once we got through some of the strike effects and whatnot, that we'd see these numbers settle down. But unfortunately, we had not. This continues to reflect somewhat of a weakening in the labor markets. I shouldn't say somewhat. I mean, it's an ongoing weakening in the labor market. Initial claims remaining low, or coming back down to low, does help mute that effect a bit. But in general, yeah, we're seeing, it's still low numbers for continuing claims, but the trend is up. So we'll see how that ends up for as we close up the year. Also on Thursday, we had the LEI, the leading economic index for October. That printed negative 0.4%. That was 0.1% below the estimates and the prior. Just going to say it's another day that ends in Y. We've had, another negative LEI print. 31 of the last 32 prints have been negative. We had 0.0, but in general, LEI is, it's been pessimistic. I will say that this toggled back to a warning signal, no longer a recession signal. They have the two metrics that they have to determine that. It's a breadth measure, and then you need to be below a negative 4.4% on a 6-month annualized basis for the LEI. We came in 10 bips above negative 4.3. So, it's still weakness being forecasted, but no longer the recession warning.
Correct me if I'm wrong, but that seems to be a new metric that perhaps the conference board threw in just to kind of cover perhaps not having recession despite the year over year being so negative at one point. But it seems like that new kind of turning it into a warning indicator sounds a little bit new to me.
Yeah, I don't recall having that, at least not highlighted in their weekly and their monthly report. On their website, I did not remember them highlighting that, going back 2 years. It seemed like after a while that became kind of a goalpost shift. But hey, maybe that's, just them trying to clarify.
Yeah, I was going to say it's just still a little bit early in calling, out of the woods yet for economic cycle. But, it seems like a lot of these traditional indicators that had worked in the past, some market, some based on survey data, some based on hard data, just don't seem to, at this point, again, early to be working.
We note on that note, we're going to go into this with the PMI data, but I believe manufacturing, we've been in this manufacturing recession, it feels like, for almost 2 years, if not longer. And that is one of the things weighing down the LEI. Usually we don't have that weak of a manufacturing economy when we have such economic strength, but that has persisted for quite some time. So that definitely makes sense. But that leads us into the S&P global PMI figures that we got released today. This is the November prelim figures. We had the manufacturing come out, yet again, a contraction at 48.8. That was 0.1 below the estimates, but 0.3 above the prior. This actually, I think it's a 4-month high now for the manufacturing print here. The U.S. services PMI number came in at a hot 57 flat. That was 2 points above both the estimates and the prior. That is the highest print we've seen going back. My eyes are tricking me here, but I think March 2022, we printed 58. That brings the combined total of the S&P, the composite figure to 55.3. That was 1 point above estimates, 1.2 points above the prior. Digging into the weeds a little bit here. Within manufacturing, actually, I want to say this PMI data, this factors in data that was collected from November 12th to 21st. So we do have a bit of a post-election take here. Now with some of that uncertainty that we've talked about in the past is settling out. On the manufacturing front, you had output. I mean, it's been weak, but it fell at the fastest rate since December of 2022. But again, post-election, there aren't expectations that are, rising for increased tariffs. You can call that U.S. protectionism. There's expectations for some looser regulation, expectations for, ongoing moderation in rates. Combine that all together, and that has led, at least per the survey, per this data set, into an increase in optimism on a forward-looking basis, and actually has led to an increase in employment growth in manufacturing. At least the report attributed some growth there to it. So we just, within the manufacturing sectors, hit a 31-month high in optimism. We'll see if anything actually comes from that. But it's also worth noting that on the inflation side, on the good side, inflation's been muted. It's been tame. But given these tariffs, there are reports of companies trying to front run some of the tariffs and try and increase the demand for the products they're going to need. And that is being noted to potentially put a little pressure on supply chains. So, the supply chain story of post-COVID world and inflation, maybe we have a little bit of a pickup if the supply chains get bogged down. But, that's in the short term. We'll see how that shakes out. Going to services, again, strong expansion, strongest premium seen since March of 2022. Service sector continues to be strong. Output rose at the fastest rate since March 2022. But employment has contracted 4 months straight. It's not to say everything's all rosy. On the inflation front, that does seem like it's settling down. On the output prices, the prices that you and I see, those are at the lowest rate they've been in the COVID era. Their input prices, with labor costs and whatnot, are still elevated per this report. But all in all, this was very strong. Some PMI data to close out, at least for the November prelim data to close out the week. And that's all I got for the week on economic data. It's very, very light.
Yeah, light indeed on the economic data. It's a little bit more substantial next week, so we'll see how that goes. But before I front myself or you, let's jump into the Fedspeak this week. It's pretty light there as well. Didn't really see anything stand out in terms of the interest rate probabilities for the Fed fund through the Fed funds futures. Not much change from what we saw last week. It came in a little bit in terms of the expectations for potential cuts in the next meeting at the FOMC that comes up on December 18th. But right now we're sitting at just a little bit better than a coin toss right here at, I see, a 55% chance of a quarter point cut at for the final meeting of 2024. And then rolling into the things that keep an eye on for next week, it will be a short week given the Thanksgiving holiday, and then some of the early market closes on Friday there. But on Tuesday, kicking it off, we will have the S&P CoreLogic 20-city HPI indices coming out. So that's something to look at. As we know, there's it's been a challenging housing market in terms of sales at this point, just given the low housing affordability. So we'll see what that has. But the prior print there was on the year-over-year basis at 5.2 for the 20-city, and then we'll see if it picks up or decelerates from there. We'll also have the FOMC minutes come out on Tuesday, so it's always interesting to see what the redacted version of the governors talking on that past meeting, see what they had to say. And then on Wednesday, we'll have the second estimate of third quarter GDP. That's expected to remain the same right now at an annualized rate of 2.8%. And then we will have durable and cap good orders, kind of give us a sense of how the economy is chugging along there. But both of those numbers are expected to be in the positive territory across both durable and capital goods. And then finally, the last day of data that we have is going to be on Wednesday. We will have personal income and spending, give us a sense of how the U.S. consumer is doing. That's expected to be positive as well on a month-over-month basis, both of those at 0.3%. And then finally, we'll have the PCE data, so kind of the wrap-up of the October consumer inflation prints there that we have. So the PCE on a year-over-year basis is expected to increase from 2.1% to 2.3% for the month ending October. And then on a core PCE component, it's also expected to accelerate slightly up from 2.7% in September to an estimated 2.8% in the month of October. So with that kind of brings us to that close of things keep an eye on prior to the Thanksgiving holiday. So that pretty much wraps it up for this week, Kimbrough. I did want to let listeners know that we will be taking a break on next week's recording of DoubleLine minutes for the Thanksgiving holiday.
Yes, thanks to all our listeners out there. We'll miss you next week. But hit us up on the X at DLine minutes, or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Yep. And you can find out more information at our website at doubleline.com. Don't forget to check out our YouTube channel at youtube.com/DoubleLine Capital, a whole host of media for people to check out in terms of insight that the DoubleLine team has to offer. Thanks everyone for tuning in today, and hope everyone has a great weekend.
Yeah, thanks all. Be safe out there and have a nice Thanksgiving.